little bit of background about Ronald Stoeferle. Oh, I got the thumbs up. Excellent. Ronald is a partner in Incrementum AG, based in Liechtenstein. Getting good at all this European stuff. He studied business administration and finance at the Vienna University of Economics and the University of Illinois at Urbana-Champaign. He worked for Raiffeisen Zentralbank in the field of fixed income and credit investments. And after graduating from university, he joined the Vienna-based Erste Group Bank, covering international equities, but especially focusing on Asia. But in 2006, he began writing reports on gold, and he gained a lot of media attention from doing that. And he actually said he expected the price of gold to rise to US dollars 2,300 an ounce, when actually at that time the current price was $500 an ounce. You can imagine the kind of comments he got at that point. His 6 benchmark reports were called In Gold We Trust, and that drew a lot of international coverage on many of the major media outlets, CNBC, Bloomberg, Wall Street Journal, The Economist, and the Financial Times. He was also awarded the second most accurate gold analyst by Bloomberg. In 2013, he became managing director and partner of Incrementum AG, and that's, as I said, based in the Principality of Liechtenstein. And that company focuses on asset management and wealth management. He continues to write the annual In Gold We Trust as a senior advisor to the Erste Group, and this is one of the things I love. I like talking to these guys before, and I said, tell me what your favorite quote is. And he said to me, whatever you are, be a good one. I like that. Whatever you are, be a good one. But he also told me it wasn't his quote, that was Abraham Lincoln. In his spare time, he enjoys spending time with his young daughter. He likes playing football. It's rugby in this country, Ronnie. Jogging and reading. Ladies and gentlemen, please give a huge Australian welcome to the only presentation he'll be doing in Australia, Mr. Ronald Stoeferle.
Thank you very much. Thank you. It works. Good evening, ladies and gentlemen. I'm really honored to be here, and I have to say I've been invited to quite a lot of conferences all over the world, and I've never had such a warm welcome like from the team of ABC Bullion. So thank you very much for having me and giving me such a warm welcome and organizing such a great evening. Thank you very much. Yeah, I'm from Austria, which is quite a long flight, and I honestly have to say I still have quite a jet lag, so if I should fall asleep, please wake me up. I'm going to wake you up if you should fall asleep. And I tried to have a nap in the afternoon, and I couldn't sleep because, you know, all of the jet lag. The body is kind of confused, so I started to think about what to say and if there's like anything for the beginning that I would like to say. And it came to my mind that in the last few months, I thought about the last few months, and it came to my mind that it seems that everybody hates gold at the moment. I issued my report on June 27th, and I had like a mildly bullish outlook. I said it's the 12-month target is 1,480 US dollars, because I said there was a lot of damage done to the price of gold and to the chart. And then I did this quote with buying when there's blood on the street, which is originally from Rothschild. And then in the afternoon, a story came up to my mind. When I met my girlfriend, it was like mid-January. I said, yeah, what did you do today? And she said, yeah, I went shopping. Said, what do you... It's like, yeah, kind of a stereotype. What did you buy? And she said, I bought like Christmas decoration. I said, why do you buy Christmas decoration in January? And she said, it's because 40% cheaper. Why should I buy it in November or in December when everybody is buying it? And I'm really sure that Christmas is coming again. So I thought, she's quite an anti-cyclical investor, yeah? She's like a contrarian, so I stick to her. And I think if you're related to gold, it absolutely makes sense. And people keep asking me, why do you call your reports In Gold We Trust? And I have to read it up because I think it's the best explanation. I do not define money merely in a technical terms as a unit of exchange, a store of value, etc., but rather something deeper. I think that money is, next to language, the most or one of the most important means of communications. So if you devalue money, you also devalue trust. And trust is what really drives our economy. You're going to a restaurant, for example, and you really trust the chef that he doesn't spit into your meal. You're sitting into a plane and you really trust the pilot that he's not going to crash. So trust is really essential. And when it comes to gold, you just have to say, okay, perhaps it's like the antichrist to fiat money. And you have to say, whom do you trust more? Central bankers? Or do you trust a currency that is around for basically 5,000 years, that preserved your purchasing power, that always kind of bought you a good suit? And from my point of view, it makes sense to go with the history and to trust gold more than our central bankers. Now, let's get it started. I know Australians are really fast readers. You did all your speed reading course, so I skipped it. Austria. It's like when I was studying in the US, I said, yeah, where do you come from? Austria. Oh, Austria's awesome. You know, all the kangaroos and Crocodile Dundee and the koalas and so on and Foster's beer. I said, no, it's Austria in Europe. Ah, isn't it a part of Germany? I said, yeah, it's a bit like that, but not really. So there are T-shirts in Austria to buy, no kangaroos in Austria. You can get them all over. Something typical from Austria, it's like, it's not my dad, but it's like how I normally dress in the office. That's not my girlfriend, sister, or mom either. But that's the typical dirndl dress. You know, that's yeah, it's kind of a stereotype, but people still wear it for like Sunday, going to church and stuff. So it's I really liked it, kind of couture. This is the Austrian, the Viennese Opera House. You know, Austria. We've been really big. The Austro-Hungarian Empire was really big. Parts of Spain were parts of the whole empire. Even parts of Mexico belonged to the Austro-Hungarian Empire. So Vienna is a really nice city to visit. I assume some of you have already been here, but it's really fun. And what else do we have? It's the Vienna Philharmonic Orchestra. Very famous. There's the New Year's concert. And there's also one coin, the Philharmonic coin. And I've been talking about trust, so I really trust you. And that's not for the prize for some game. I'll hand it around. I'd love to see it afterwards, but have a look at it. And we've got some security guys over there, so it's a really nice coin. And the thing is that if I'm talking to Austrian investors, we're not really familiar with the mining business. It's not really important in Austria. I tell them, you know, the average grade at the moment is like 1 gram per ton. So for one ounce coin, you have to move like 31 tons of rock. That's quite a lot, and it's quite costly. So that gives you some sort of a perspective on the industry. Yeah, that's skiing. That's like our biggest thing, the major sport that we are really good at. And there's also something else. Those old gentlemen, they're Austrian economists. And the Austrian School of Economy, it's not about our education system or anything. It's a school of thought. It's basically quite the opposite from Keynesian economics, which is unfortunately more important at the moment. That's Karl Menger, Eugen Böhm-Barwerk, Ludwig von Mises, Friedrich Hayek, and Murray Rothbard, who continued to teach at, he's American, but he's like the last generation of Austrian economists. So I thought about easy comparison for the Austrian economics, and I had another kind of strange idea before. It's like if you compare Keynesian economists to Austrian economists, it's like a bit, if you go to a doctor, you've got a bad cough, you go to the doctor and you say, yeah, it really hurts and I want it to get better. And the Keynesian doctor would probably say, take some pills, swallow some syrup or anything. And if it doesn't get better, yeah, take more, and it's gonna better anyway. The Austrian economist or the Austrian doctor would probably say, okay, you've got a cough, do you smoke? I say, yeah, smoking like 3 packs a day for 40 years now. Okay, makes sense. And perhaps, why do you smoke? Yeah. So the Austrian economists try not to treat the symptoms. They try to understand the roots and the causes for the problems that we're in. And I think happenings like, Lehman Brothers, Greece, those are all symptoms. But it's systematic, and I think the real problems that we're having nowadays, and that probably will get worse, they're based on our monetary system. So, very important quote from Eugen Böhm-Warburg: political decrees can never override economic laws. And I think that's quite essential when it comes to now. You had elections quite recently, so I think everything is going to be all right in Australia. New government will make it. We're having elections in 2 weeks in Austria. Yeah, if I follow the news coverage, it's pretty interesting what they're saying. Even the party that was 22 years in the government says, yeah, now we have to unleash the economy, we have to lower taxes and so on. But yeah, we'll see. But as the Austrians said, political decrees can never override economic laws. So yeah, pretty lengthy introduction. The status quo of the bull market, is it a correction or a reversal? As I've said before, I released my last report on 27th of June. Gold was trading at 1,200. I sent it out and it traded down to 1,160. I felt like the most stupid person on earth for doing such a bad call. And I got phone calls and emails, people saying, kind of ridiculing me and saying, yeah, okay, really good call. But I've been quite lucky. That was the low of this correction so far, hopefully. And I wrote in the last report that this is quite similar to the mid-cycle correction in the 70s. As you know, the last big bull market in gold happened in the 70s. And there was one big correction going on from 1974 until 1976. And you can see it in gold. So I did an index to make the comparison easier. So gold was basically trading at roughly 200 in 1974, and then it corrected down to 105, something like that. And it took like 450 trading days. So the correction was from December 30, 1974 until August 31, 1976. Now if you compare it to the recent correction, September 5th was the all-time high at 1,900, down to June 27. It was a bit more, like 450 trading days, but it's kind of similar. And I think when you compare the sentiment, and I did some research, I went to libraries and had a look at the newspapers back in the days in the 70s, everybody called the end of the bull market. The sentiment was extremely negative. We've had disinflation, we had economic numbers getting a bit better. So I think it's quite similar. And what happened afterwards? It took almost 2 years until gold reached the old level, which was like at 200. So until it marked new all-time highs. And that's basically what I also said at the beginning. It's going to take time to repair this chart picture. I've been talking to a lot of wealth managers and I say, no, gold, I won't touch gold. And I'm absolutely certain that I won't be buying gold until it probably hits like 1,500, something like that. But they're acting normally very pro-cyclical. So going forward, that would mean like that we'll hit like the 1,900 again in roughly 2 years. So it would be like 2015. But as you know, we had this big mid-cycle correction. And afterwards, gold made a pretty decent run, so from the low at 100 up to almost $850. So from my point of view, the best is still to come. What you see here are the corrections within this bull market. The first report was sent out, I think, this time, so I had a pretty lousy timing and said, yeah, when it was trading like 500, 550, I said, yeah, gold will probably rise to new all-time highs. It did eventually, but people were really, really negative about gold. Then we've had the big correction, like minus 30%, 2008, 2009. They also called the end of the bull market. Yeah, sentiment was extremely negative. And now, this is a logarithmic scale, you're also seeing a correction which is 33%. But you can say from the blue bar that this correction just takes longer. And as I've said, I think that's a natural shakeout. Gold is coming from weak hands, more speculative traders, to really strong hands, mostly in Asia when it comes to physical gold. So what happened during the correction? And I remember I was in Zurich at a gold conference in April, and you cannot believe how what kind of things happened at the bar late at night when gold was collapsing like crazy, and all the mining guys were really nervous. It was quite something to remember. What are the reasons for this takedown? Richard Russell once said, gold always does what it should be, it just never does it when we think it should. And I think that's quite accurate. What you're seeing here is the combined balance sheet of the Fed, the ECB, Bank of England, and the Bank of Japan in trillion US dollars. So you can see quite a high correlation. There were some phases when we had some sort of monetary deflation or monetary disinflation. And what we've seen recently, I mean, the Federal Reserve and the Bank of Japan, they're printing like hell, but the ECB and also the Bank of England, they were kind of, they had some sort of monetary disinflation. So I think that was one of the reasons, but the major reason was that we are seeing rising real rates. And basically a disinflationary, so decreasing price inflation and rising real rates, that's basically the worst environment you can have for the price of gold. Absolutely. Then we've had the outlook of quantitative easing being tapered and eventually exited. Gold has priced in that there's going to be some tapering in September, probably like 20 billion per month. Then we've seen partly declining money supply, I've said that, record high short positions. So I did a presentation mid-April and said from a technical point of view we're having extremely high short positions. And I say from my point of view they have to cover at some point. For example, in silver we had the highest short positions in 20 years. And I've thought that would trigger some sort of a short squeeze, so on the upside. I got it wrong, I have to admit. So many market players, banks, they really made a fortune during this takedown, and some others lost quite a lot of money, but those shorts are kind of cleared. We're seeing rising opportunity costs of owning gold because, you know, we've had the peak in 2011. Since then, the S&P has risen more than 40%. So if you own gold and you're not allocated in equities, at some point you just throw in the towel because, you know, why should I be invested in gold when stocks are rising and making new highs? Then we've seen tightening credit spreads. Everybody believes that the situation in the Eurozone is getting better. We've seen at 1530 some sort of cascading sell orders. So 1530 was like a very obvious technical limit. So as soon as we went below in very thin trading, they're like CTAs, managed futures and so on, kind of worsening this downtrend. That was a major factor. We've had increasingly negative analyst opinions. Goldman Sachs, Societe Generale, Credit Suisse, basically all the big investment houses who were kind of bullish on gold are nowadays negative on gold, which makes me confident as a contrarian. Margin calls and forced selling from underperforming hedge funds. We've had a firmer US dollar because of some confidence coming back for the outlook for the US growth. And most importantly, I think, there's a very high level of conviction that the central bankers will get it right. And now one question to the audience. Can you find a single example of a crisis that was caused by deficit spending, too much debt, and too much currency debasement that was solved with further deficit spending, more debt, and more currency debasement? I don't think so, that there's any example from history. So why do I believe that this bull market is not over? First of all, we have not seen any event or major policy change that is associated with the peak. For example, Paul Volcker, beginning of the 1980s, he increased interest rates dramatically. He was the most hated man on earth. It was a pretty tough situation for the US. But after 2 years, economic numbers increased dramatically. We have not seen any such a major policy change yet. Gold producers have not made significant new highs. So normally, at the end of a bull market, the gold mining stocks would have to outperform massively. They haven't so far. The monetary climate has not changed. QE has not been discontinued by any central bank yet. When it comes to the US, for example, everybody's talking about tapering, perhaps they'll decrease it like 10 or 20 billion a month. But still, this is much more than QE2. And the Federal Reserve always says, okay, whenever it's necessary, we can increase it. So they're driving like 240 kilometers an hour and just going a bit off the gas pedal. But it's not a brake that they're doing. So I think there's no real change happening. Nobody has any real idea how global central bank balance sheets will be normalized or what the impact could be of removing 5 to 6 trillion from global central bank balance sheets. So the potential for future paper money debasement is very big. Short-term interest will remain negatively or extremely low until 2016. I will talk about that a bit later, financial repression. Afterwards, they will be raised only very gradually. Therefore, real short rates will remain negative or very low for the next year to come. And gold's behavior leading up to 1,900 and its subsequent decline bore none of the hallmarks of a classic secular top. Normally, you're seeing this blow-off top at the end of every trend. Remember NASDAQ stocks in 1999, 2000. Remember oil in 2008. It was like trading at 80 in May, and then it rose up to 147 within a few months. That's normal. Like this blow-off top, this mania phase is normal at the very end of a bull market. We haven't seen that yet. Confidence in gold among developed world financial macro investors has been shaken. Confidence in gold, particularly physical gold, among emerging market investors and central banks remains unshaken. And when I'm talking about gold, many people say, yeah, you know, when you're bullish on gold, you have to be negative on everything else. Always like, yeah, the pessimistic guys who really pray for financial Armageddon to happen and everything to blow up. But it's not like that. I think it's some sort of monetary insurance. And on the other hand, there's this so-called fear trade. So people are buying gold because they have got some fear of hyperinflation, monetary debasement, and just those kind of things. But there's also the so-called love trade. So nations, emerging market nations, China, India, Thailand, Mexico, for example, they're buying quite a lot of gold. Emerging markets, physical demand in 2011 was 70% of the total demand. So Austria, Germany, Switzerland, for example, in Europe, they've got some sort of affinity to gold because of, you know, hyperinflation in Germany and in Austria. But at the rest of Europe, people don't really care about gold. I once went to London into a normal bank branch and said, can I buy an ounce of gold? They were laughing like mad. It was like, for them, it was like so unreal to ask for a ounce of gold. So when it comes to this love trade, I think that you really have to think in about emerging markets and how their purchasing power will continue to grow in the future, and with rising prosperity there, they probably continue to buy gold. But it's not only like the people, it's also the central banks in emerging markets buying gold. The fall in gold in 2013 has taken gold from weak hands and put it into stronger ones. Janie already said that in April, for example, the volumes were really high. And I can tell from my own experience talking to clients, those guys who really have the long-term view, they were piling in gold during the correction. So I think there are different sorts of players in every bull market. And therefore I think that like the more short-term or medium-term players, they sold their gold and they sold it to the really strong hands who believe in this long-term bull market. Yeah, Janie and Jordan, they asked me for some view from the ground. A picture speaks more than 1,000 words. It's a really nice cartoon. So the German guy is coming home from office, doing late hours. The guys are sitting on the couch having a beer or a cocktail and say, these came for you. That's like the bills. And I have to say that the developments in Europe are quite worrisome for me. Because we've talked about it before, there's already some sort of secession movement, for example. I talked to Bavarians and they said, like the southern Germany, Baden-Württemberg, but also Bavaria, they are basically economically very strong. They are subsidizing the rest of Germany. And I say that's okay. But they also say we don't want to subsidize the rest of Europe. So in Bavaria, I think that has a long way to go, but there's already some sort of secession movement. They said, okay, we can do it on our own. We have to be part of Germany. So I don't think that this is really happening, but there's some things that you can say that developed recently. What's going on in Europe? The German Institute of Economic Research recommended compulsory bonds to deal with over-indebtedness. Normally, such bonds are only issued during wartime. They've never been issued during peace times. So they say that the forcible levy to the tune of 10% on all wealth exceeding 250,000 euro would bring in 230 billion for Germany's budget. And they're really serious about it. Then Boston Consulting Group, for example, they recommend something similar. Their senior partner, Daniel Stelter, I know him. He's also some sort of advisor to the German government. He proposes a combination of capital levies, wealth taxes, and an inheritance tax. So I think there's more of this to come. It's going to happen. For the Eurozone, I think, yeah, Greece and Portugal, I'm going to talk about it a bit later on. But the real big problem for the Eurozone is going to be France. And I think that's going to happen probably next year. They have to refinance quite a lot of bonds. The state at the moment is responsible for 57% of GDP. So the debt to GDP currently is 90%. Foreign holdings of French debt are 50% higher than those for Italy and 4 times higher than those for Spain. Because investors became concerned about Spanish and Italian debt, so they piled into German bonds, but also into French government debt. When it comes to unemployment, it is at a 15-year high of 11.2%. I think the official, like the real numbers are a bit higher. And it has risen for 28 consecutive months. Youth unemployment is at 25.7%. When it comes to youth unemployment, Spain, it's like 40% at the moment. Italy is, I think, 37%. So that's a really big issue in Europe. You heard about the solutions by the French government, for example. They introduced like a tax for the super wealthy people. Gérard Depardieu, the actor, he said, no, I'll become a Russian citizen. I don't want to pay like 75% taxes, and I think that's just fair. So it's highly populistic, and honestly, if you have a look at their industrial production numbers, it's getting worse and worse. So I think France is really going to be the big test for the Eurozone. And some pictures, and I have to say that's not what's commonly going on in Europe, but just to get a sense what's already happening in Greece, for example. There's really bad riots on the street. That's the Catalans in Spain. They want to, I talked about the secession movement. The Catalans don't want to be part of Spain anymore. So there were, Jordan just told me, there were hundreds of thousands of people on the street protesting. So those are really worrisome developments. And those kind of things, I don't like it. And every time I see it on the news, I'm kind of scared. If you're talking to like the generation of my grandparents, they're really nervous and concerned about such things. A friend of mine has just been to Greece, and he said it's really depressing. People are suffering tremendously, and if there would be a referendum asking, do you want to leave the Eurozone, he said would be like 80% of the Greek people would decide to leave the Eurozone. But the problem is probably that there's no rules or no laws for countries leaving the Eurozone but staying in the European Union. So nobody knows if that's possible at all. So a few predictions. Angela Merkel will slide a landslide victory in the elections. It's on 22nd of September. It's probably gonna be a big coalition from my point of view. And after the German elections, we see another bailout for Greece. Portugal will probably request a major infusion of capital. And as I said before, France and Spain will be the real test for the Eurozone. Long term going forward, the funny thing is that the Eurozone is a highly political idea. And when it comes to, when you're talking to politicians, they're absolutely certain that this is the right way to go and that people really want it. When you're talking to people, they say, we don't want to be in a super bureaucratic state and everything is governed by Brussels. But politicians obviously don't really care. So there are like parties in Germany coming up, the AfD, Alternative for Germany, which will probably make like 7 to 10%, and they're extremely Euro skeptic. Some countries, Greece, Portugal, will probably, going forward in a few years, leave the Eurozone. I think that the ECB will have to become much more aggressive. And the bigger picture is that EU leaders are still focused on band-aid solutions when a major surgery is needed. And a very wise comment, the enormous debt that now oppresses all the great nations of Europe will probably in the long run ruin all these great nations. Who said it? Oh, Adam Smith, 1776. So history repeats. Again, Adam Smith. History shows that once an enormous debt has been incurred by a nation, there are only two ways to solve it. One is simply to declare bankruptcy and repudiate the debt. The other is to inflate the currency and thus to destroy the wealth of the ordinary citizen. Jordan has been speaking about the whole debt situation. Fact is that we're seeing at the moment, media is kind of focusing on the Eurozone, but I think that the debt situation in the UK, Japan and the US is just as bad. What you're seeing here is the annual budget deficit and surplus. So it's mostly deficits, as you can see. And I just had a look at the forecasts by the Congressional Budget Office. It's like the official institute that publishes the forecasts for the US budget, and they're saying that for the next 10 years there's going to be a total budget deficit of 8,400 billion, so 8.4 trillion US dollars. Okay, it's quite a lot of money. But as you know, such long-term forecasts, it's a bit like with big building projects. It's like in Austria, for example, like the big railway stations underground, big tunnels and stuff like that. It normally takes double as long, and it costs most of the time 200% more. So I think the numbers by the CBO are highly confident and optimistic. And if you dig a bit deeper into the numbers, how they calculate it, the assumption of the CBO is that within the next 10 years, average real growth will be 3.5% in the next 10 years. Okay. Unemployment numbers will come down to, on average, 5.5% within the next 10 years. And they expect that there's not going to be any recession within the next 10 years. So I think that won't probably happen. I think their numbers are they are based on a very positive scenario that probably won't work out. So the new debt since 2008 amounts to more than 40% of the total accumulated debt of the last 240 years. So you can see that it's kind of picking up momentum. If it's not possible to achieve surpluses even in times of economic prosperity, then the problems must be systemic. And here again you can see from 1971, end of Bretton Woods, you see most of the times deficits, and they grew bigger and bigger. And demographics, as Jordan said at the beginning, that's probably the big long-term shadow, the big dark cloud over us, and that's, you cannot basically change demographics so fast. And I think Japan is probably the biggest, like the elephant in the room, and the facts are on the table when it comes to their debt, to their demographics, and therefore I think that's really going to be the major problem going forward, because they reach the Keynesian endpoint. And if Greece, Portugal and so on, if they already cause so much trouble in the economy, what's going on if Japan blows up? It's going to be pretty volatile. So from my point of view, when it comes to debt, there's only very little scope for significant increases in interest rates due to the high interest payment obligations. What you're seeing here is US bond yield since 1870. So we hit a new all-time high last year. That's when Paul Volcker stepped in. And so we've seen 10-year interest rates at all-time lows in the US. We've seen also for the short maturities, we've seen negative rates. So investors paid the Austrian and the German government to be able to deposit money at them, which is kind of strange. The Netherlands had the lowest level of yields in over 500 years. Japan had yields near record lows. So as I've said at the beginning, there's only very little scope for significant increases in interest rates because of these high interest payment obligations. For example, at the moment, should US yields rise to 7%, which would be not unusual, then servicing the cost for the US Treasury would increase from currently 450 billion to 2 trillion, which is 80% of their tax revenues. This so-called death zone is already lower in the countries like Greece, Italy, and Spain. It's roughly 6%, and in Japan, it's already much lower. So an increase of the average refinancing cost by 3 percentage points would consume the entire public revenue. So there's only very little wiggle room for interest rates to rise. And therefore, I think when people talk about gold, I often hear gold is a bubble. I say, yeah, okay. If it's your point of view that it's a bubble, it's okay. But I think the big bubble is really in bonds. So the hunt for yields, if you're talking to institutional investors, they have to produce some yields. There are no yields in government bonds at the moment, so they went to the corporate sector. And now they basically went to emerging markets. But for example, Mongolia, they issued 1.5 billion, which is 20% of their GDP, at a yield of 5.1%. Rwanda, which was bailed out by the IMF within the last 10 years for 3 times, they issued bonds at 6.6%. So I think the real irrational exuberance, as Alan Greenspan famously said, is in bonds at the moment. The yields on bonds amounting to 20 trillion US dollars are nowadays below 1%. So that's the real problem. And as I said, investors have to hunt for yield, and this is producing very negative effects. And therefore, I think that more and more capital is going to be allocated to very dubious low returns. And this ultimately undermines the productivity of capital. I talked about the Keynesian endpoint. That's a chart which is really impressing. It shows the increase in real GDP per dollar of incremental debt. So in the 1940s and 50s, for one unit of debt, it had an effect on real GDP of 4.6, and nowadays it's 0.08. So Keynesians say, okay, it doesn't work now, so we need more. We even need more and more and more, but it doesn't work because this marginal utility is just constantly decreasing. And sad but true, Dad standing with his two little kids in front of the big debt mountain, and he said, someday all this will be yours. And just a little guessing game. I talked a bit about Japan, for example, before. They reached 1 quadrillion yen of debt. So 1 quadrillion, that's quite a big number. It's a 1 with 15 zeros. A quadrillion is a million billion. Now one question. If you would take up to 1 quadrillion, and if it would take you 1 second for one number and you wouldn't sleep, how long would it take you to count up to 1 quadrillion? 31 million years. So that's a really big number. And if you would stack it in 1,000 yen notes, how high would this stack be? 1 quadrillion? I got no idea how far the moon is. 70,000 miles high, but I think the moon is probably further away. So that's quite a big number. Now, what are the solutions? Ludwig von Mises said, no very deep knowledge of economics is usually needed for grasping the immediate effects of a measure, but the task of economics is to foretell the remoter effects and so to allow us to avoid such acts as attempt to remedy a present ill by sowing the seeds of a much greater ill for the future. So I think at the moment, kind of the plan for politicians is financial repression. That's like the big buzzword. There are papers that suggest that financial repression already worked after the wars, but we have to say that the demographic setup was much more positive after the wars. There was real growth because we had to build up whole industries, whole countries. So I think it doesn't make really sense to compare financial repression now to the days after the World War II. Now, basically, you've got a few choices. You can make spending cuts. You can make marked tax increases, or a more subtle method, which is financial repression. There was a survey, really interesting, by Bridgewater, and they said as soon as you cut like 3% of GDP, the incurring of riots on the street and strikes and so on is rising dramatically. So you cannot cut too much of your spending. So basically, I think what we're going to see is financial repression going forward. And this is Mr. Jean-Claude Juncker. He was the head of the Eurogroup. And this guy, he really had some great comments. First of all, he said, make no mistake, we have instruments of torture in the cellar and we're going to show them if necessary. But he also said, I have to say that's one of the most important politicians of the Eurozone. He also said, when it gets serious, you have to lie. Then he said about the decision making, we decide on something, then put into the space and wait a while to see what happens. If there is no hue and cry and no uprisings, because most people have no idea what was decided there, then we go on step by step until there is no turning back. So there's no wonder that population really doesn't trust politicians anymore. So what are the main pillars of financial repression? First of all, strict investment regulations like Solvency II, Basel III. So there's no need to hold risk capital if you invest in European government bonds under the preference of attractive liquidity ratios and non-existent risk. For gold investors, probably the most important fact when it comes to financial repression is negative real interest rates. Then there are interest rates, ceilings, nationalizations. For example, in Austria, we had a bank in Carinthia, bailout 17 billion euros, which is quite a lot for Austria. We are having regulations of cross-border capital movements. For example, in Brazil, you have to pay a duty on capital inflows. The prohibition of unwanted trading practices such as naked short selling, for example. Compulsory loans, I already mentioned it. Prohibition of certain investment assets, for example, gold. Now, normally the question arises, gold confiscation. Do I have to hurry up? Okay, but we've got 2 more hours, right? Prohibition of certain investment assets. I don't think there's going to be a real confiscation, but they're probably going to make it harder to invest in gold. Yeah, so there's probably going to higher taxes, but basically on paper gold from my point of view, because it's just easier to tax it. In Germany, for example, there was the VAT on silver was 7%. Now they raised it to 19%. So if you're paying a physical silver in Germany, you have to pay 19% VAT, which is quite a lot. Special taxes, really great ideas. Security taxes, financial transaction taxes, wealth taxes, higher value-added tax on silver, I already mentioned it, and import duties on gold in India, for example. So those are the measures where you want to investors to kind of avoid investing in gold. And that is, from my point of view, probably the most important chart for gold investors. It's showing the last big bull market, and we've had, in the 70s, we had 54% of all months, we have negative real interest rates. Then, I mentioned Paul Volcker already, he raised interest rates, so real rates rose to up to 10%, and this was the end of the big bull market. So for 20 years, you were quite stupid to hold gold because you roughly had negative real interest rates, mostly positive rates, so the opportunity costs of holding gold were really high. And now since 2001 or 2000, in 56% of all months we're having negative real rates. And as I've said, financial repression is gonna be kind of the solution, and based on the whole debt situation, I don't think that interest rates will rise dramatically, so I think we'll see very low or negative real interest rates going forward, and that's a very good environment for gold. Big question, inflation or deflation? Peter Schiff, one of my favorites, says, in fact, all great hyperinflations result from a deflationary bust that the government attempted to prevent from happening by printing money. And I think the best explanation when it comes to inflation and deflation that I ever heard is like if you compare it to 2 tectonic plates. Normally the market clearing process would be highly deflationary, but politicians kind of want to avoid this deflationary process and want to compensate it with inflationary policies. So those 2 tectonic plates are working against each other, and it's a bit like with earthquakes or volcanic eruptions and so on. Those things that you're seeing on the surface, quite big disasters, they're having their roots and their causes like down there at the tectonic plates. And I think now central bankers are doing quite an okay job to avoid this deflation. That would be normal, but I think they will do way too much, and they will be way too dovish and be too late on the curve when it would be time to take away the punch bowl. Yeah, we know the remarks by Ben Bernanke, Deflation, Making Sure It Doesn't Happen Here. I brought a book that, Hannah, how much time do I have? 5 minutes or 5 hours? Okay, thank you. Okay, thank you. It was sent to me. It's called Modern Central Banking Simplified. And as Mr. Bernanke, and it says, it's a quote from this remark. It says, the US government has a technology called a printing press, or today, its electronic equivalent, that allows it to produce as many US dollars as it wishes at no cost. So that's his comment. And I was really curious about the book. And it says, print money, print money, print money, and at the end, keep on printing. So that's really modern central banking simplified. And the funny thing is that this book sells on Amazon for $10. So I think the author really did a good job, yeah. But why I think that they will try to avoid deflation at all costs, it's very easy. Price deflation results in a real increase in the value of debt and nominal decline in asset values. Debts could no longer be serviced. You would see massive tax revenue declines for the government due to a declining taxable base. And deflation is, for our financial system, it would have fatal or lethal consequences. And one also important mandate of central banks is they have to ensure financial market stability. So therefore, I think they will avoid deflation, which would be the normal clearing process at all costs. A look into the future, quantitative easing number 56. Miss Pelosi, Ben would have wanted it this way. Gold hits 1 million per ounce, still holding at price of a good man's suit. We already had that one. Oops. And that's what's basically happening. That's this chart you can see. It's an index, the comparison of the central bank balance sheets since 1999. So the Chinese were kind of the masters of monetary inflation. They did a really good job. Afterwards, Federal Reserve, up by 600% since 1999. And then Eurozone, UK, and Japan. And if you compare it in US dollar terms, you also see that the Chinese really inflated their currency or their monetary base quite dramatically. Now, I said people really trust our central bankers, and they've got really big trusts in Bernanke and also Mario Draghi to get it right. But if we're having a look at the track record of his cause, he said, well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline on house prices on a nationwide basis. July 2005. The impact on the broader economy and the financial markets of the problems in the subprime market seems likely to be contained. March 2007. The Federal Reserve is not currently forecasting a recession. January 2008. The GSEs, government-sponsored entities, are adequately capitalized. They're in no danger of failing, so that's Fannie Mae and Freddie Mac, July 2008. And there was an interview, the question was, you have what degree of confidence in your ability to control inflation? Bernanke said 100%. And that shows you this sort of hubris, this ivory tower that those people are sitting in. So he's really, really committed. And then I don't believe significant inflation is going to be the result of the central bank's quantitative easing measure, January 2013. So the Fed has moved from central banking to central planning. I have to hurry up, I think, a bit. Since 2009, the correlation between the balance sheet of the Federal Reserve and the S&P index has increased to 86%. So the stock market is highly dependent on the printing presses. Central bankers are getting quite religious. And this is my very, very favorite one. You really couldn't make this stuff up. It's Mr. Kuroda, head of the Bank of Japan. And he's basically showing what the Bank of Japan is going to do. They just double the monetary base. Yeah, I think it's a brilliant, really a brilliant idea. Yeah, I said at the beginning, from my point of view, you have to dig a bit deeper, and I think the whole mess started in August 1971 with the end of Bretton Woods. What you can see here is oil measured in gold, pretty stable since 1971, so it preserved your purchasing power. And on the other hand, dollar measured in gold and dollar measured in oil are down by 97%. So if you say gold and oil are rising, or you could also say the purchasing power of the dollar is just constantly decreasing. You need more and more units to buy 1 ounce of gold or 1 barrel of oil. It's basically the same. So oil measured in gold, very, very stable. Yeah, history repeats. This is a really interesting quote. The budget should be balanced, the treasury should be refilled, public debt should be reduced, the arrogance of officialdom should be tempered and controlled, and the assistance to foreign lands should be curtailed, lest Rome become bankrupt. People must again learn to work instead of living on public assistance. Cicero said that, and there you can say that history does repeat. And that's also, in ancient times, they didn't call it quantitative easing, they just reduced the weight of the silver or the gold coins, or they just put in more copper. So at the end, it was like, at the beginning, it was like the denarius was like a 98% silver coin. At the very end, it was like 0.0% silver and the rest was copper. And they also did coin clipping. So they just clipped it away to decrease the value. Yeah, I could talk for many more hours. I'm really sorry. But just one more essential thing, I think that the so-called stock-to-flow ratio is really important when it comes to understanding gold. What I'm showing here is the average rate of change of gold versus M2, monetary aggregate, low, high, and average. And the low for the rate of change of gold was 1.4% since 1868. And for M2, it was minus 15%. But the high, so the year when M2 was increased the most was 26.4% for M2, but only 3.5% for gold. And on average, your natural inflation of 1 ounce of gold is 2.1%. So that's the annual flow compared to the total stock that is available. And that shows you this relative scarcity of gold. And this also explains why people have trust in gold, because you cannot inflate the amount of gold at will. Why gold is still no bubble? I think it's pretty obvious. World financial assets, 231, it should mean trillion, because billion is trillion in German. So institutional investors at the moment still only hold 0.15% gold. And I think we can talk about the bubble if this hits the cover of Time magazine, the great gold explosion, why we are going gaga over gold. Dow gold ratio at 1.1. Gold hits 15,000. Gold stocks outperform S&P, and JP Morgan says gold is screaming buy. So that would be time to become a bit cautious about gold. Just a very short-term view, as I said at the beginning, we didn't see this parabolic blow-off in gold yet. In the 1970s bull market, the price of gold doubled within 6 weeks. So we're seeing a rather constant and steady increase. Seasonality, as you know. Sentiment is extremely negative. Serge on Temple said bull markets are born on pessimism, they're grown on skepticism. They mature on optimism, they die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. That's pretty easy, and I said it at the beginning. As you can see here, public opinion on gold is extremely negative. So, yeah, my long-term target for gold that I already issued like in, I think in 2007, is 2,300 US dollars, which is the inflation adjusted all-time high. I honestly think that gold will go higher, but I also have to admit that I really don't hope that gold will hit 10,000 or 20,000 US dollars, because then I think we'll have serious trouble. and then it's not going to be a really nice environment that nobody should really hope for. So I think the secular bull market remains intact. We're going to see negative real interest rates going forward. We're seeing a continued loss of confidence in capital market, and Leonardo da Vinci brilliantly said, simplicity is the ultimate sophistication. So from my point of view, gold is simple, it's effective, and it's reliable. And it's reliable means to hedge against systemic risk. And one more quote, the very last one. The English proverb, when we have gold, we are in fear. When we have none, we are in danger. Thank you very much for the attention. I really enjoyed it. I hope you enjoyed it. Where is my coin?
Where's your coin?
Where's the coin? There's somebody hiding.
Where's the coin? Somebody's got his coin. Ladies and gentlemen, one more big thank you for Ronald Stoeferle. Ronald,
thank you very
please.
much.